Hello, everyone, and welcome to Ancient Roman Trading Secrets with General Romulus. That's me right there, Romulus. We have a great show for you today. We're going to be talking about interest rates and earnings and window dressing. And if you don't know what window dressing is, well, stick around. You'll find it interesting. Okay, as usual, this show is brought to you by Backpack Trader. Our goal is to help you become the best version of the backpack trader you can possibly become. All right, interest rates it is. That's where we will start, although I do have a chart up here of the S&P 500. That's mostly where I leave my screen. Why is that? Because the S&P 500 is the single most important stock market indicator or symbol or anything that you want to pay the most attention to. If you spent nothing doing anything else other than watching, analyzing, and trading with the S&P 500, you would probably be fine. Okay, but interest rates, well, they're interesting, right? Yes, they are. They have been kind of hovering around a bit at these very elevated levels. Prices, or interest rates rather, on some of the government points, highest that they've been in quite a long time. 10, 15 years as a matter of fact. Even with a little bit of a pullback in here, they're still extremely high. And we know the Federal Reserve is not done raising interest rates at their meetings. There's another meeting coming up. These things come around like Swiss trains, everybody, but the next one is coming up in about a month, late July, and they will raise interest rates again. It will be at least a 50 basis point rise, 75 point more likely. There's even slight discussions about a shock of a 100 point increase to really get this inflation train. Boy, I'm full of train analogies today, aren't I? This inflation train off the tracks. However, you could see also that there has been a little bit of a slowdown in the rate of ascent. This is something we talked about in the Romulus Legion Nation back there in the first couple of weeks of April. That clearly has been taking place. Why is that? Well, the rate of increase was simply unsustainable, that's all. You don't want to look too much more into that. It seems to me that inflation is going to be more like we saw in the 1970s. Well, how many people listening to this, watching these videos, and actively working today were also actively working in professions back in the 1970s, other than, God bless him, my father. My father guy's fantastic. Okay, CPA, 51 years, I believe, still doing the tax audit work. The guy is just an absolute animal. But let's face it, most people look around your cubicles and your hallways, your colleagues, your coworkers. Most people are under the age of 70. If they're under the age of 70, then they really weren't working in the last inflationary period, which is why this is catching so many people off guard, specifically with the latest round of nonsense going on in crypto crazy. Everyone involved in the crypto industry is under the age of, let's say, 45 or 40 even. They have no idea, and they're getting their heads absolutely handed to them. It's like every other day, there's another total wipeout, another total disaster of the crypto space. This time it was CoinFlex. CoinFlex supposedly can't collect money from somebody, but the CEO is telling their investors, look, this guy was great. He was fantastic. He was an upstanding person. Fine. Did you get any collateral? Well, he said he was upstanding. Okay, how about collateral? Well, he showed us investments. He had a lot of investments in other cryptocurrencies. Okay, well, that's been wiped out. What about collateral? Well, he showed us investments in other venture capital companies. Okay, that's not collateral. What about a factory? What about a car? What about a house? What about land? What about equipment? Any of that stuff? No, of course not. You have no idea what that stuff even is. Although over the next 2 years, you're going to find out, and it's going to be the hard way. Okay, which is one of the reasons, by the way, why companies that have assets are holding up better in this entire bear market than companies without hard assets, because people are flocking to these ideas. It is still a mystery to me why gold is not higher. Speaking of hard assets, we were told a year ago from the crypto crazies that crypto had an inflation hedge to it. It was going to be fine during an inflationary environment. This is when inflation was just starting to be talked about in the general public, in the general world. That obviously proved to be total nonsense and not held up at all. And other aspects of the crypto space were crumbling around. But I was of the theory that, hey, one of the reasons gold wasn't going higher for a long time is because many people that would buy gold were just attracted to the run of crypto in the last 18 months, and they were buying that instead. Well, they've been selling crypto, but they're not buying gold either. So that's kind of an interesting thing to me. Put some comments below in there. Let me know what you think about gold. I'm a little curious about it. The chart doesn't look good. It doesn't look terrible. I mean, I've seen worse looking charts lately, so have you, but it doesn't look good either. There's not really a bullish category going on in here. Not a lot you can say and support an upside movement over coming days, weeks, or even months. But again, back to interest rates. That's where we started this conversation. They are kind of hovering around. I believe these highs will be taken out in here, okay, sometime between now and the end of the year, but it could be a bit, And I don't think that the rate of ascent that was taking place from April, May, June, July of 2020 until recently will be seen again, and that's probably going to be through your lifetime. I know that kind of a comment sounds a bit odd, but you probably will never see that. How do I know this? Because that rate of ascent, that rate of increase was the only time it's ever happened in U.S. history dating back to 1792. So you probably aren't going to see that again for the rest of your life. Now, on to earnings, next topic of conversation. We won't see earnings come out for just a little bit. 4th of July holiday, that's this weekend. Monday, markets are closed. Next week, that does bring us the first week of July, but there aren't really any earnings coming out. First ones will be the banks. That's typically what goes on. And you can see JP Morgan's got their big purple E up here, which means that their earnings are coming out July 14th, okay, a couple of weeks away. That's usually the first big company out there to release earnings, banks and JP Morgan specifically. Then a few more banks, broker-dealers. We've got Goldman Sachs and, Goldman Sachs here, Morgan Stanley, Bank of America, companies like that. And then a little bit down the road will be the tech companies. So in late July, you've got Apple. So the earnings are being scheduled right now. Here's Apple, July 26th. So starting about mid-July to the end of the month is when the earnings come out. That's still a bit away. Nothing really going on there. Again, Federal Reserve meeting also in the last week of July. What you should expect, though, and here's something that could be useful, is companies are going to continue to pre-announce their earnings. So first we got warnings from Target. Then we got a huge warning from Snap. Then Microsoft came out. We're going to see a little more of that going on over the next couple of weeks before the actual earnings come out. And there will be negative warnings. Companies typically, not always, but typically don't come out and warn to the upside and say, hey, we're going to be a lot better than we thought. It's going to be to the downside. And analysts, the major analysts of the big money banks, they're still way off on their earnings estimates. They're still much too rosy and cheerful. Don't think, though, that just because a major analyst downgrades his earnings, that's going to bring the market down. One of the reasons the market is already down is because the market sees the future, and that has already been somewhat, I say somewhat, priced in to the market so far. Okay, so before we get into window dressing, which is a little bit of the topic right now, markets are up a bit in here. You could see rallying from the June 16th, 17th low. So far, that's the low of the bear market. That's the low of the bear market. You may have noticed, though, that what we have here, and we have to kind of extend the data, is a series of lower highs, okay, and lower lows. That's a definition of a downtrend, and it's still very much in place. Okay, markets have to get smartly above this area, this purple line, to kind of negate that, and I don't see that happening anytime in the near future. Maybe later on in the year, late October, November, December, that could happen, but not anything in the very near future. A lot of people still looking to get some of their money back from the stock market as prices rally. A lot of people need money right now, like we go back to this CoinFlex story from a minute ago, and these people are looking to collect on debts that they're owed. Again, a lot of debt money going through the crypto world, and they're trying to find real assets. That's going back to what we spoke of a minute ago. They're trying to identify real hard assets that can be sold in order to repay these things. They don't want crypto. They don't want reputations. They don't want venture capital, unicorn investments, because that's not real. That doesn't allow someone to sell something right now and get their cash in their hand. And that's what people want right now. They want cash in their hand. Okay, so last thing we wanted to go over today, window dressing. What does that mean? How does it affect us as traders and investors? Window dressing is the somewhat common practice. It's not official, but somewhat common practice of money managers, either pension funds and mutual funds and hedge fund people, those kind of people, the big money players, to mark asset prices up, take them higher into the last couple of trading days of a given quarter, which is right now. They do that so that when they have their investment committee meetings starting in a few weeks, they say, hey, look, we're okay. We're fine, our prices are up, even if the asset prices fall back the first day of the new trading month. They simply want them up at the end of the quarter because that's when the reporting comes out. That's when their meetings take place, and that's what they'll be talked about. This is particularly important right now. Why? Because the first and second quarter of 2022 has been so terrible. Okay, as a matter of fact, they say this is the worst start of the first half of a year dating back to, 1932 or something like that. Just really awful. A lot of people are out there saying, well, yeah, but the 6 times that this has happened where we've had such terrible first half returns, the second half was great. Well, a lot of that comes from 1932. The bear market, the biggest, most terrible bear market in stock market history, started in October 29 and ended in May of 1932. The Dow Jones Industrial Average fell 90% from high to low. So the rebound from there was just amazing. I mean, it was tumultuous and fantastic and explosive. And that skews a lot of the numbers, just that one event, because of how much power was coming off that and how much of a rebound took place from the May of 1932 low. However, we'll see. Okay, we'll see. I mean, I'm certainly willing and able and interested to go long the stock market. It's just not time. It's just not time. S&P 500, these lows will be tested at the very least, and most likely taken out to the downside by some amount. Maybe not a ridiculously large amount, but by some amount at some point between now and the end of September. So, hey, this has been your old buddy Romulus. I've really much enjoyed talking about interest rates, earnings, and window dressing. Now that you know what it is, you have a little cocktail party and 4th of July party talk, huh? Excellent. I'm heading back to ancient Rome. I will be back tomorrow, and I'm already looking forward to it. That's all for now.